But let's do engineering really quick on Tesla.
Yes.
I like to buy Tesla on that. I think that's a great opportunity to buy Tesla because I think the opening is going to do well.
Did you know that Jim Cramer is a believer in Tesla stock? These days, Tesla bulls and bears are almost the same numbers. Some have been very vocal about their doubts about the company, while others express their optimism about the company's future. Although, of course, both bulls and bears have their respective sound arguments. Jim Cramer, in a recent segment of Lightning Round on CNBC's Mad Money, stated that he likes Tesla and that the company has a great long-term situation.
And I was wondering if
like Tesla. I think it's a great long-term situation.
I'm never going to bet against Elon Musk, said the Wall Street veteran and Mad Money host. It's a sleeping giant now, Cramer said on a CNBC Squawk on the Street episode in mid-January. At the time, Tesla shares rose, although several analysts cut their Tesla price targets. Cramer indicated that Tesla may be immunized from negative coverage at the current levels. It can be noted that before Tesla announced its Q4 2022 financial results, analysts highlighted the downside potential in Tesla shares as they were expecting a disappointing earnings report next week. In response to the analyst notes, Cramer said, "Well, no kidding," adding that's why the once high-flying stock is down more than 40% in just the 3 months prior. Notably, Cramer, who was known as the Tesla skeptic that later turned into a bull, shared that everyone is pretty much aware that the EV maker has been cutting prices for its lineup of electric vehicles.
Some of these published reports today say the automaker is set to cut December Model Y output at Shanghai.
But despite this, Cramer explained that Tesla actually has the margins to do so. With this in mind, Tesla may prove more resilient than expected. "I just don't want to bet against Tesla when it's down so much," Cramer said at the time. Even now, Cramer expressed his trust in Tesla's CEO, Elon Musk. For the past several months, it was evident that the financial industry and the stock market in particular have been extremely unstable. In a late January statement, Jim Cramer claimed that strong earnings from Tesla, along with the United Rentals, helped lift the market. He said that it can be credited to a batch of strong company earnings, including that of Tesla. In yet another CNBC Squawk on the Street episode in early February, Cramer revealed that given the choice between Ford and Tesla stock, he would rather own the latter today. It is worth noting that his statement contradicts his December statement. At the time, Cramer said that Ford is a rising force in the electric vehicle sector, and that Tesla was beginning to lose share.
It's unbelievable. Have you been in the Mustang Mach-E?
I haven't, Jim. No.
It's incredible. Have you been in the GM Hummer?
I have not, Jim.
It is outstanding. I always hated every other EV. Suddenly, I'm thinking, what the hell am I doing with an ICE?
Really?
But yeah, because these car companies are delivering EVs that make me say, you know what? This is no longer Teslas. They still are the dominant player. But the other ones that are coming out, wow.
He further noted that Ford's goals, particularly with regard to the ramp of the F-150 Lightning, are something worth watching. Understandably, though, a lot has happened since then. For one, Tesla initiated a price cut to its entire lineup in January, making all its vehicles more affordable to buyers. Further, Tesla executives, including CEO Elon Musk himself, shared during the Q4 and FY 2022 earnings call that the company's orders were the strongest in our history, and almost twice the rate of Tesla's global production. On the other hand, Ford's recent results showed that the company still has a way to go before its electric vehicle business becomes as fine-tuned as Tesla's. Ford CEO Jim Farley admitted as much, stating that we should have done much better last year, and that we left about $2 billion in profits on the table that were within our control. That was a really bad miss, and Jim Farley has to make it this quarter. I'm selling this now, Cramer said. Cramer added that Tesla's got no more insider selling, which he thought was good. He also noted that he would not be surprised if longtime Tesla bulls, such as billionaire investor Ron Barron, would show up on air and say that Tesla is worth $1,000 soon. Apart from Mad Money host Jim Cramer, several other analysts are bullish on Tesla stock. Among the analysts who recently shared their thoughts on Tesla was Jefferies' Philippe Houchois, who maintained his buy rating on Tesla shares but reduced his price target to $180 from $350 around mid-January. While Houchois noted that Tesla still leads the industry, he noted that affordability might be a key challenge in the electric vehicle sector. Most OEMs are just emulating Tesla at various paces, and speed remains a critical competitive edge for Tesla in an industry largely stuck in zero to negative-sum game of transition, the analyst noted. Notably, other firms also changed their tune on Tesla in early January of this year, after a rough year last year. Edward Jones changed its hold rating on Tesla stock to buy in the first week of January. We believe Tesla's new product launches will allow it to take advantage of this expanding market, analyst Jeff Window wrote in a note to investors. In our opinion, the share price of Tesla does not reflect its long-term growth opportunities. The analyst commented, Tesla's stock price has declined significantly over the past year due to concerns of slowing economic growth and Elon Musk's time spent managing Twitter. While slowing economic growth could pressure near-term auto sales, we believe the electric vehicle market will continue to expand due to global regulations. Global regulations on emissions and mileage are driving the growth of EVs. While competition is rising, we expect Tesla to continue to have a significant presence in global markets, writes the analysts. They continue to argue that new products and technologies would help improve profitability. Programs that have software or ongoing subscriptions, such as full self-driving, are especially important for Tesla, as they are expected to be more profitable. Additionally, Tesla is working to improve manufacturing efficiency and reduce costs. Specifically, ongoing design improvements with batteries should reduce cost and help to improve profitability, the analyst added. Window shared their belief that Tesla's new product launches will allow it to take advantage of this expanding market. In our opinion, the share price of Tesla does not reflect its long-term growth opportunities. Tesla has above-average price movement both up and down relative to the market, due in part to shifts in investor views about the future of the company, which depends on growth in the EV market, Tesla maintaining significant market share in EVs, and the success of new business ventures. In a note to clients, Window described Tesla stock as looking affordable given the potential for the company's long-term growth. He also said he expects Tesla's full self-driving FSD beta to continue improving, along with the automaker's EV batteries. Additionally, Window pointed out Tesla's plans to launch new products this year, including the upcoming Cybertruck as well as the potential rollout of an updated Model 3 design later this year. The stock movement this year has been eye-catching, Window admits. However, Tesla maintaining significant market share in EVs and the success of new business ventures is ultimately dependent on investor sentiment. Tesla has above-average price movement both up and down relative to the market, which has been caused by significant shifts in investor views. Arguably, Tesla is a great growth stock. This is evident in how volatile and susceptible to large drops Tesla has been. It is important to keep in mind that a key trait of growth stocks is both high risk and high reward. What makes Tesla such an exciting stock right now is that its fundamentals are finally catching up with the stock price. The argument that Tesla is being priced for what it could become far into the future isn't as easy to make now that the stock has collapsed. Today, Tesla has undeniably grown to become a very good company. It has an industry-leading balance sheet, operating margin, top and bottom line growth, and free cash flow. And a lot of those strides have come in the past 2 to 3 years as Tesla has gotten more consistent with its profitability while keeping up its torrid growth rate. Still, some tend to think that Tesla is just a car company. However, note that production and deliveries would have to grow several times to justify Tesla surpassing its previous all-time high. But if you're in the camp that Tesla can monetize its electric semi-truck, robotics, and autonomous and self-driving technology, and grow its renewable energy business, then Tesla, 25 years from now, could follow in Microsoft's footsteps and be a completely different company with a much higher valuation. Overall, the risk-reward for Tesla makes a lot of sense at these levels. However, those who choose to invest in Tesla would have to be prepared for a bumpy ride. Take into consideration that as a pure-play electric automaker, Tesla should be valued differently than traditional automakers that are transitioning to the technology. That's because Tesla enjoys pure growth in the EV industry, while its rivals are cannibalizing their existing products with electric alternatives, a strategy that could cost them total market share over the long term. That said, while some industry watchers believe Tesla's business is slowing after a series of price reductions in China, investors should remember that the price cuts come amid a broader auto industry turndown amid high inflation, high interest rates, and consumer confidence. Tesla's management remains optimistic for the long term, expecting vehicle delivery growth averaging 50% annually over a multi-year horizon. Subscribe to Tesla Stock for more.